For many years, India has dreamed of matching China's power, not just in population, but in technology, trade, and global influence. In almost every major industry, from electronics to steel, India has seen China as the competitor to beat. And now, this rivalry has reached the automobile sector, one of the most important battlegrounds for future economic strength. Recently, India has taken some striking steps to slow China down. It's building closer ties with Western countries, especially the United States and Europe, and positioning itself as the democratic alternative to Chinese manufacturing. But at the same time, India is also setting up serious roadblocks for Chinese businesses operating in its market. In 2024, the Indian government imposed tariffs of up to 30% on certain steel products imported from China, a move clearly aimed at hurting Chinese exporters. On top of that, India has made it harder for Chinese automakers to enter its domestic market, demanding strict reviews, extra approvals, and even technology sharing before allowing investments. These policies mark a turning point in Asia's industrial competition. India is no longer just competing quietly, it's openly challenging China's dominance. But the big question is, how will China respond? Because when it comes to global trade, every move has a counter move. And now, signs suggest China is preparing one. A decision that could shake the foundation of India's auto industry and test its entire Make in India dream. So why is China suddenly refusing to invest in India's automotive sector? And what kind of ripple effect will this have on India's economy? Let's break it down, step by step. To understand why China's countermeasure matters so much, we first need to look at how far China's auto industry has come. Not too long ago, Chinese cars were often dismissed as cheap copies of Western brands. But things have changed, dramatically. In the past decade, China has transformed itself into the world's largest car exporter, outpacing even Japan and Germany in total volume. According to data from the China Association of Automobile Manufacturers, between January and August 2024, China exported 3.21 million vehicles, a massive 69% increase compared to the same period last year. That means in just 8 months, China almost matched its entire 2023 export total of 4 million cars. How did China achieve this? The answer lies in electric vehicles and smart technology. Chinese automakers like BYD, NIO, Chang'an, and SAIC have turned electric cars into global sensations, offering advanced batteries, longer driving ranges, and futuristic designs at far lower prices than their Western rivals. In countries across Europe, Africa, and Southeast Asia, Chinese EVs are now outselling traditional brands. For example, BYD's electric models have become so successful that even Tesla feels the competition in global markets. These cars are often 20 to 30% cheaper than similar Western models, yet come loaded with cutting-edge features like AI-assisted driving and fast charging systems. This sudden dominance has made many nations uneasy. Western countries fear their automakers can't keep up, and countries like India, which also want to build a strong car industry, now see China not just as a business competitor, but as a direct threat to their ambitions. Because if Chinese EVs keep flooding global markets, India's dream of becoming an auto manufacturing hub might stay just that, a dream. And that brings us to the next part of the story, India's own ambition to rise as an automotive power, and why it has struggled to get there. For years, India has wanted to replicate China's manufacturing miracle, to become the next big factory of the world. One of the key areas where India hoped to shine was the automobile industry. The government launched big campaigns like Make in India to attract global automakers and turn the country into a hub for car production and exports. On paper, it sounded promising. India has a massive workforce, a fast-growing middle class, and a population that's hungry for affordable vehicles. But there was one major problem. India lacked the advanced technology and manufacturing systems that make a car industry world-class. To fix this, the Indian government decided to open its doors to foreign companies. It relaxed investment laws, allowing foreign ownership of up to 15% without prior approval. The message was clear: come build in India. Bring your technology, create jobs, and help us grow. The hope was that foreign automakers, especially leaders in electric and smart vehicle technology, would set up factories in India. In return, India would gain access to modern production methods and gradually raise the standards of its own car industry. It was a smart plan in theory. By working with global giants, India could fast-track its industrial growth, just like China did decades ago when it welcomed Western car makers such as Volkswagen and General Motors. But turning theory into reality is never easy. India's complex regulations, high taxes, and sometimes unpredictable policies made many companies hesitate. And soon, two major examples, Tesla and BYD, showed just how difficult it really was to bring those ambitions to life. At first, it seemed like India's dream was finally coming true. Back in 2019, Tesla, the world's most famous electric car maker, announced plans to build a factory in India. The news spread quickly, and excitement grew. Many believed Tesla's entry would completely transform India's auto industry and attract other investors to follow. But years passed, and nothing happened. Tesla didn't buy land, didn't build factories, and didn't even launch local production. Why? According to industry experts, Tesla realized that entering India wasn't as easy as it looked. The company would face a maze of regulations, heavy import duties, and potential tax penalties. On top of that, India's demand for electric vehicles was still low at the time, meaning Tesla could risk losing money. So, despite early optimism, the plan quietly faded away. Then came BYD, China's electric vehicle giant and one of Tesla's biggest rivals. In 2023, BYD announced a massive $1 billion investment plan to build an EV factory in India. The project promised thousands of jobs and advanced technology transfer, something India claimed it wanted. But surprisingly, the Indian government rejected BYD's proposal, citing national security concerns. Behind the scenes, reports suggested India's officials had demanded BYD share its core battery and software technologies as a condition for approval. That's like asking Coca-Cola to reveal its secret recipe before selling in a new market. A request no company would ever accept. Faced with this demand, BYD decided to walk away. The investment was canceled, and India lost what could have been a major boost for its EV sector. These back-to-back failures, Tesla pulling back and BYD being blocked, exposed a deep problem. India wanted the benefits of foreign investment, but it also wanted tight control. That combination scared off many potential investors and left India's automotive ambitions stuck in neutral. But here's the real question: why did India act this way? On the surface, India's rejection of BYD's investment looked like a decision based on national security. But if we dig a little deeper, it becomes clear that there's more to the story. India's main concern wasn't just about security, it was about competition. Chinese electric vehicles have a massive price advantage. They often cost 20% less than similar Western or Indian models, yet they offer almost the same quality, technology, and comfort. If Chinese automakers like BYD or Chang'an were allowed to set up factories in India, they would dominate the market in just a few years. For local Indian automakers, that would be a disaster. Brands like Tata Motors or Mahindra simply can't match China's scale or efficiency yet. So from India's point of view, allowing Chinese EVs in could crush its domestic industry before it even has a chance to grow. But there's another layer to this: politics and alliances. India has been strengthening ties with Western countries, especially the United States, which has been critical of China's rise in the EV sector. By limiting China's access to its market, India positions itself as the trusted partner of the West, a manufacturing alternative to China. In other words, India is trying to win Western favor by showing that it's willing to stand firm against Beijing. So India's rejection of Chinese investments wasn't just about protecting its industry, it was also about choosing sides in a global economic rivalry. However, such decisions always come with consequences. Because when a country takes action against China, Beijing rarely stays silent. And soon enough, China began preparing a countermeasure that could deeply hurt India's auto ambitions. As BYD's electric cars roll deeper into Europe, the story is far from over. What started as a trade issue is now transforming into a defining moment for the global economy. Will Europe's new tariffs slow China's momentum, or simply make BYD smarter, stronger, and more local? One thing's clear. BYD isn't backing down. The company has already proven it can adapt, innovate, and compete on any terrain, from Asia to Latin America, and now in Europe's backyard. Its message to the world is simple. The future belongs to those who build it. For Europe, this moment is a wake-up call to rethink how it competes in the new era of electric mobility. No longer can it rely solely on tradition or brand prestige. Innovation, affordability, and sustainability now rule the game. This new era will test not only automakers but entire governments. Will they cooperate or clash? Will the world choose protectionism or open competition? These choices will shape how fast humanity can move toward a cleaner, more connected future. At the end of the day, this isn't just BYD's story. It's a story about all of us. Because the cars we drive, the energy we use, and the technology we create are no longer just tools of comfort. They're symbols of progress, independence, and survival in a rapidly changing world. Final question for the audience. Do you think Europe and China will eventually find a balance, competing but still cooperating for a greener planet? Or is this just the beginning of a long economic showdown over the future of energy and mobility?